And hopefully, yep, it took. Let us go. Mm. So before we get into the meat of things, I just wanted to share this quote with you from Albert Einstein. The hardest thing in the world to understand is the income tax. I concur, have been practicing. This is my 24th tax season, and we're just about learning every day because it's just some kind of new law, some kind of new change, not at the only at the federal level, but at the state level. So thought I would share that to kind of brighten our mood this evening. So today's outline, I'll be going over kind of a summary of the American Rescue Plan Act, along with a breakdown in areas that I definitely feel is important for us to pick apart and look at in detail. I'll be talking a little bit about the stimulus payments, who qualifies, what is the timeline for getting those payments if you haven't received them already. And then I'll be shifting gears towards the small business relief, specifically talking about, the updates to the PPP loan, the targeted EIDL grant. There is this new restaurant revitalization grant, which is huge, and then shuttered venue grant, which came with the December bill, but there has been some updates to it. And then lastly, I do have some information about the family employee retention credit, and I have a miscellaneous provisions that didn't quite make it into my deck, but I did create slide for us just to quickly mention. Within the presentation, I will say in advance, it's a bunch of different links. Once again, if you didn't hear me at the top of the hour, I will be emailing you or link to the recording of this webinar along with the deck itself in PDF form. So those links should be usable, hyperlinked within that PDF document. So if you don't quite get to write the whole address, it's okay. It'll be in that PDF document. Just a little bit about myself, you guys. For those who do and don't know me, I am a practicing CPA, licensed in Maryland and Virginia. I currently hold my master's in taxation from American University. I first started out in public accounting in a firm based in Bethesda, Maryland. And currently the solo practitioner of AGA Group. And to date, I've prepared or reviewed over 65,000 tax returns. It's hard to believe that, and that number is growing. And just the fall of last year, I began doing online platform trainings for other CPAs, accountants, tax attorneys, enrolled agents, as well as bookkeepers on how to build a successful tax practice. I do sit on the committee as an appointed member for the IRS NPL, meaning National Public Liaison, on their SBSE division, which stands for Small Business and Self-Employment. And essentially what that is once a month we come, most of the time virtually or by way of phone, and we talk about different tax law enactments and how that impacts the taxpayer, from the wording on the tax forms and instructions and so forth, to even they get to talk to us about what they're looking at or what they've been targeting as far as examinations, what are red flags. So obviously I take that information and apply it to our tax return so we can stay under the radar. And then lastly, I do spend a lot of time now catering to small businesses and entrepreneurs. A little bit about the firm. Your small typical CPA firm. We were started in November 2007. During tax season, we currently house about 8 staff members. Post tax season, it's more like 5 to 6. We're right outside of Washington, D.C. and Lanham, Maryland. We do service clients not only nationally, but internationally. And currently, we do service complex tax preparation, small business accounting and consulting, which is a monthly service, tax resolution, which refers to anybody that's having problems with the IRS or state because they owe a lot of taxes, or perhaps they haven't filed in a number of years. We do help them, represent them, and get them compliant and assist with resolving their tax debt issue. And lastly, we do business and corporations. There is a note there that we are phasing out taking on new clients when it comes to the tax preparation piece. As much as I am thankful and grateful for all of my clients that refer business to us, it's with a heavy heart having to come to that decision. But we're kind of assessing our assets in terms of experience and value, and we feel that it is most valuable to be of service to those that are small business owners as well as having tax troubles. So we will be beginning to focus exclusively on that in the near future. A little bit about the team. To my far left, hopefully it's your far left too, is Brianna Briscoe, and she's an admin as well as one of our fellow tax preparer. In the middle, we have my sister Mona, who's been with me for about 7 tax seasons. So she comes kind of moonlights and she's in on the weekends helping us with the tax prep. And anyone that's a client on this webinar knows Mr. D, Dwight Martin, who's our office manager, and he's the wonderful smile that you see when you walk in the office most of the time, because we do have someone else that is sharing that position as well, or answering your calls. To my far left, maybe your far right, is KC. This is the other lovely individual that is greeting clients by way of walk in at the front desk or on the phone. And then we also have Shamir, who does purely tax preparation. She comes from the public accounting world. And the last 2 individuals, our bookkeeping team, is Santosh and Farouk. They work remotely, so they handle all of our small business bookkeeping and accounting needs. So that's the team. So let's get into it, you guys. So first things first, IRS did extend the due date for, and just make sure I don't need to admit anyone, and I don't. So IRS did extend the due date. We kind of expected it. The Commissioner Chuck Redding said that if we were to have this third stimulus to be passed, it's more than likely that we would have an extension, and now there's an extension only for 1 month though, until May 17th. And the extension is for individuals only. So corporate tax deadline is still April 15th. And the extension allows for additional time to contribute to your IRA or your HSA, your health spending account. As far as Maryland goes, the state has extended the due date to July 15th. And one thing that federal didn't do, they did not extend the estimated payment for first quarter 2021 as they did last year when they extended to July 15th. So 2021 Q1 estimated taxes is still due April 15th. So the only thing extended at the federal level is the 1040 tax return. The other thing with Maryland, this goes for all filing entities, so not only individuals as well as businesses. And mostly all other states have at least extended to the IRS deadline of May 17th. So I try to capture the states that we do a lot of we do taxes returns in those particular states. And then lastly, this is an automatic extension, so you don't even have to do anything to get the extension for federal to May 17th or for state. It's all automatic. All right. The kid and caboodle. So I thought this little video, this Jiffy was perfect for trying to understand this whole $1.9 trillion American Rescue Plan Act, we calling it ARPA. But this was a nice graph that I found online to kind of give us a breakdown of where the money is going. So yes, it's part of it is to help out for the stimulus payments for individual tax relief. Then we have, a portion going for small businesses, but states and government have also been awarded aid in terms of facilitating for schools so they can get the necessary monies that they need to actually, you know, set up for vaccination and set up for vaccination as well as set up for their state government buildings and so forth. And there has been some expansion to the unemployment insurance in terms of not only getting that additional PUA income of $300 a week extended, but there's some income exclusion that we'll get to talk about a little bit later. As you can see, there was monies contributed or a portion for transportation and infrastructure. We'll be talking about this expanded child tax credit and earned income tax credit. So there was a lot that was in this bill that, we may have just thought it was just small businesses and individuals. So with the breakdown of ARPA, as I mentioned, that this came into signing on March 13th. I think I said earlier, March 11th. And the pieces that I'll be pointing out is what I thought would be impactful or useful for my clientele. So we'll be talking about the recovery rebates, which is the stimulus payments, earned income credit being expanded, the expanded and fully refundable child tax credit and dependent care credit. Talk about the unemployment relief, the premium tax credit being modified, student loan forgiveness income exclusion, and a little bit about the COBRA premium subsidy. So that will be on the individual side. And then on the small business relief side, we'll talk a little bit about the EIDL, the PPP loans, the employer retention credit, that revitalization grant, the shutter venue operators grant. And as we get towards the end, it'll probably be less and less information. And as part of this document, like I said, the PDF, it will have a link to additional bill provisions just in case you were interested in finding out what else. And it's like an 8-page document, but it's useful. It's an easy read. So that'll be in the PDF. And lastly, we'll kind of go over some miscellaneous provisions, as I mentioned earlier. So as per the section of this plan, ARPA 9601, it's already was designated that it was 2 previous payments, stimulus payments. Now we have 3 separate payments. So just kind of going back in time, which just feels like was a couple of months ago, but last year around this time, they began sending out the first stimulus payment, which was $1,200 per taxpayer, plus an additional $500 per dependent under 17. And those payments went out between April and September 2020. And then in January, this past January, the second stimulus of $600 per taxpayer and dependent under 17 went out. And now we have this final and latest stimulus of $1,400 per taxpayer and dependent, and it does not have any age restrictions. So that's the cool thing about that. So if you have those older kids going to school and you're claiming them on your tax return, then you would have gotten would have gotten $1,400. Now, the payout for this third stimulus is they started it on March 14th. I know a number of our clients, as well as people I know, have started receiving their stimulus payment of the $1,400. They are set to do the second phase in these upcoming days. But the bill states that if you didn't receive it, you will receive it based on your 2019 filing or your 2020 filing. And if you can you can, when you file your 2020 tax return, you'll get it from 60 days from the date of filing or September 1st, whichever date is earlier. With 2020, this is not part of the act. This is kind of FYI. With the 2020 taxes, we are reconciling the first and second stimulus. And what that means is if for whatever reason you didn't receive your first stimulus or your second stimulus, then you would get a credit on your 2020 tax return. If you're usually used to getting a refund, then your refund will be higher to account for these two stimulus payments that you may not have received. And we're going to talk about some planning things because there is the question of, okay, well, when I go to file my 2020, I didn't quite qualify for when I filed 2019, but when I go to when I go to file 2020, would I qualify for these two payments? And the answer is yes. So technically you possibly could qualify not only now for the first two, but also for the third stimulus payment, because in 2020 your income went down, you may have gotten furloughed or laid off or something like that. And the other thing to note here is that if you received, and it could have been the opposite. So you made more money or you made less money in 2019 and you made more money in 2020, then the question is, well, do I have to pay it back since I received stimulus payments based on my 2019? And the answer is no. So there are no repayment provisions on this. But there has been a big change from the first and second stimulus in terms of what qualifies versus this third stimulus. So it is much lower than the first one, and we call it a cliff, and I'll explain that in a second. So if we look at this chart, the AGI, which means adjusted gross income for the first and second check, if you filed single and your taxes were 0 to 75,000, then you are okay. You got 100%. And as the case for head of household and married filing separately. But if your income went above, and my apologies that the head of household and married filing separate box is empty. Then for example, for single tax filers, if it went above 75,000 and it was under 100,000, you got some portion of the first two stimulus. I believe it gets knocked down $5 per $100 over that amount. The difference with the third is that the phase out is much smaller. So it's still the same, 0 to 75,000. You're okay to get the whole 1,400. However, between 75 and 80,000 is the phase out, where with the first stimulus and second stimulus phase out, it was between 75,000 and 100,000. And for married filing jointly, it would have been the 150,000 to 200,000. So as you can see, the phase out is between 150,000 to 160,000. So that means if you report $1 over this 160,000 married filing jointly or 80,000 married filing, single, then you get nothing. So I did offer a link if you wanted to check to see how much you're receiving in advance. And in the next screen, I'll talk a little bit more about planning opportunities as far as, with the first, second, and possibly third stimulus. So a couple of things to note with this stimulus payment. If a taxpayer is deceased before the beginning of this year, it's as if they didn't have a social security number and they would not get a rebate. this third stimulus would not be used to offset any type of federal or state or bank garnishment or third party collectors. The only only offset that can be used for the stimulus payment is for child support. So I actually had someone share with me that they had a negative bank balance and the money came in, their 1,400, and that 1,400 was their balance that they were able to take out of the bank account, although their bank had a negative balance in there because the bank could not garnish or use that money towards their bank balance. Another thing to note in the previous rule, for the first two stimulus as compared to the new rule for the third stimulus, is that resident aliens and green card holders and workers using visas such as H-1Bs and H-2As were able to get the stimulus payments. But if they did not have a social security number, then they were not typically allowed to get it unless they had what, I'm gonna skip down here where it says must have social security or if it's an adopted recipient that has an I-10. The one thing that came out of ARPA bill is that they have this new rule called mixed family status, which means that all the members in a family that are not required to have a social security number, but if they do have an I-10, just as long as one of the family members have a social security number, then the whole family will receive $1,400. So that is huge. If you do not receive your third stimulus by at the latest September 1st, 2021, there will be a reconciliation, just like what we're doing on 2020 for the first two stimulus payments. On 2021, there will be a form that we would need to complete to say whether or not you got your third stimulus. And if not, once again, you'll get a credit against your taxes on your 2021 tax return. And if you don't typically file a tax return, IRS does have a portal online where you can actually submit your information and, submit to get your stimulus payments, which is that link where it says non-filers. So I do know individuals that all they do is collect Social Security, so they don't have to file, or, they didn't make enough money to have to file a tax return. They were under the $12,000. So because of that, they would go here and actually go to get my payment off of irs.gov's website and submit their information to get their stimulus payments. Some planning opportunities is that I've seen where it's been a very long tax season, although we got 2 months to go. And that every tax return, we are individually looking at clients' adjusted gross income for 2020, comparing it to 2021. What was their filing status? How many dependents? What are the age of the dependents? Because there's just so many planning opportunities surrounding them maximizing receiving their stimulus. And what I mean by that is if 2019 income was lower than 2020, then we're holding off from e-filing the tax return and asking clients to, hey, let us know once you get that third stimulus, and then we'll hit go on the e-file. We're looking at the ages of the kids. So if they're over the age of 16 and perhaps they are going to school, and or they have a job, where we're advising clients to have their children claim themselves, because when they do over this age, they are getting essentially $3,200, which is the first stimulus, the second, and the third, versus if they were on their parents' return, the parents would just be getting a $500 credit. So that has been a game changer. So I just did one the other day. The kids are all over the age of 17, I believe, between 19 and 22 in school. Some work part-time, some are jobs. And they were all being claimed in 2019 on the parents' return. We have them claimed by themselves this year. So that's essentially $9,600 that they would be getting in addition to what the parents have already received, because they did qualify for the first and second stimulus. And I even think they received the third stimulus. So to the extent that the parents didn't do their 2020 return, and they received all three stimulus based on the 2019, it's still okay for the children to file 2020 tax return and yet again collect on these three stimulus, although the parents did receive it on their 2019. So just it's wonderful opportunities here based on the fact scenario for clients that this stimulus rebate is there and available to help families out and individuals. The next area to talk about is the unemployment. So currently, the unemployment was due to run out in sometime in March, I believe March 15th or March 16th, right before the bill got passed. And now it has been extended until September 6th. So not only was there an extension of the additional benefits, so if anyone's receiving state unemployment, they not only get the state piece, but they also get this pandemic unemployment assistance piece called PUA benefits on top of that. With the ARPA bill, they also allowed for 2020 and 2021 taxes to allow taxpayers to exclude up to $10,200 per taxpayer. There is a cliff, which means that if an individual or someone married filing separately or head of household, if they make 75,000 or less, then they get the full 10,200. But if they make $75,001, it's a cliff where they get nothing. So that's the only thing with that you have to be under that amount. So I do have clients that did receive unemployment, but unfortunately they are over the threshold for the income, and not by a couple of dollars, because we can have them do an IRA contribution or something like that, but they just don't qualify for any. So there's no phase out like with the stimulus payments. It's either you get it or you don't, based on your adjusted gross income being at 75,000 or less, or 150,000 or less for married filing jointly. There was some concern with the early filers of 2020 because, once again, this was retroactive to 2020 taxes. So you did have early filers that claimed unemployment, and the concern was, well, we then need to turn around and amend their returns so they can get this exclusion of the $10,200. And IRS just released 2 days ago that no, they're going to be automatically making the adjustment and notifying the taxpayer, which is so great. And then the last thing to note is that the $10,200 exclusion is the lesser of that amount, or the actual amount of the unemployment compensation. So if you received $5,000 in unemployment, then your exclusion is $5,000 and not the $10,200. And for married filing jointly, if you both received unemployment, you're each capped at the $10,200. So if the husband had more than $10,200 in unemployment income, and the wife had less than 10,200, they don't automatically get the max of 20,400. The wife will get the max amount that she received, which is less than the 10,200, and then the husband will get up to the 10,200. State is also allowing the exclusion for unemployment. Maryland is saying at 100% exclusion, but we're actually still waiting for the tax software to update, or Maryland to update with the tax software providers, so we can start pushing these state returns done. So it's been, like I said, a fiasco this tax season, because you just have so many different moving parts to determine, okay, do we e-file, do we not e-file, do we wait for the client to get the stimulus payment, or we got to wait for Maryland for the unemployment so we can get it all excluded and not just the 10,200. So I must say I will be ready for a long break after this tax season for sure. All right, let's talk kids. I mean, it's been a huge change with the ARPA bill for child tax credit, and this is only for 2021. If you have a social security number and you live in the US and that's your primary residence, what's different for 2021 is that the child tax credit it increased from $2,000 to $3,000 for any child that's 6 years or older and up to the age of 17. And it's $3,600 for any child under 6 years old. There is also a phase out, though, similar to the phase out for the third stimulus payment. It's much lower. So currently for the $2,000 child tax credit, you can make up to $200,000 as a single individual or $400,000 as Murray Fallon jointly before your $2,000 begins to get phased out. With this additional amount of that $1,000 or $1,600, depending if the child is under 6 years old, it is gradually phased out at just $150,000 or more for Murray Fallon jointly, or $75,000 for single, or $112,500, and that's just a $1,000 piece. Once you max out of that phase out, you don't get that $1,000 or the $1,600 additional, but you still are allowed to get that $2,000, that base amount. But once again, for families that are under this 150,000 and that may have 3 kids, this is a huge credit for 2021 for them. Continuing on with the child tax credit, they are allowing for advanced credit payment. So what that means is the ARPA bill states that IRS is to set up a portal, which they already said they're not likely to have it set up by July 21st because most of their employees are working virtually, not coming into the building or offices, and they are actually in the process of trying to hire staff. But so half of this credit is to be paid in advance in what is called like monthly installments. And it's supposed to start July 1st, but the credit is for the whole for the whole year of 2021. So if someone qualifies for the credit, take 50% of that credit for the child tax credit, divided by 12 months. And then on July 1st, technically, they're supposed to receive the first 6 months of 2021 at that time, and then the equal monthly payments thereafter. So I know it sounds confusing, so I put an example here. So it reads, taxpayer has a 5-year-old dependent and earns less than the $75,000 a year. So there's no phase out of that, or they'll get the whole $3,600. The TP means taxpayer. The taxpayer qualifies to receive $150 a month. And that is calculated by taking the $3,600, because the child is under 6 years old, and dividing it by 2, which gives us $1,800. And we take that 50% of the credit and divide it by 12 months, which equals $150. So the initial payment for the first 6 months would be $900. And then they'll receive $150 from August to December. There is an allowance once the portal is up that you can opt out to say, I don't want the credit. in advance, I'll just take it on my 2021 tax return. And as it states on the slide here, it would automatically be based on your 2019 and 2020 income. The other reason that the portal is not only to be used to opt out, but you can also update. So new banking information, new address, because IRS is required to write to you and provide you a statement to let you know what the amounts are going to be and for perhaps for what child or children, that you can actually go in there. So if you had a baby born in 2021, or if you file head of household and every other year you're claiming your child because the other parent claims them, and this is the year that you claim them, you can go in there and put their information in so that so IRS can account or calculate the credit for you for this year. And it states that the monthly payments from the US Treasury will be by way of direct deposit. I didn't put this on the slide, but there is a repayment requirement if, like I said, if you go over that $75,000. So when you go to file 2021 and you realize, okay, my income was too high to get the full $3,600 or $3,000 credit, depending on your income amount will determine whether or not if you have to repay some of it, which is a partial, all of it, or a complete exclusion. So I did not put that in the slide, but the act did call for repayment provisions if you were to exceed the allowable adjusted gross income. Another huge change for the dependent care credit under Section 9631 of the Act, and this is also only for 2021, that this credit becomes fully refundable as the child tax credit. So what I failed to mention with the child tax credit is that you may have enough credit. Let's say you claim 3 kids, they're all over the age of 6, $3,000. You and your wife are under the 150,000. That's $9,000. Where your tax bill may only be 6,000. So generally in the past, if your child tax credit was 9,000, then you can only use 6,000 to offset your tax bill of the 6,000, and you just kind of lose that 3,000. Well, with this being a refundable credit as well as a dependent care credit, this will allow that additional 3,000 to come into your pockets because it's a refundable credit. So huge thing for anyone claiming or families claiming children. So with the dependent care credit, not only is it fully refundable, but there had always been a max of $3,000 per child for the first 2 children. So the max that you can do was $6,000 and up to 35% of $6,000 in qualified expenses for daycare. Now that is increased from 3,000 to 8,000 per child. So the limit is now $16,000, with the credit percentage not being 35% of 3,000 or 35% of the max of 6,000, but now 50% of the total qualified expense amount up to 16,000. So 50% of that would be $8,000 for 2 children, maxing the dependent care credit. Huge. There is a phase out between the 15,000 to 125,000, and as far as costs are concerned. The other thing to mention with the dependent care is that the dependent care piece is you can do it through your employer through the flex spending account, and normally it would be a $5,000 limit. Now they've increased that to $10,500. So you can either do the flex spending account up to $10,500, or you can do this refundable credit. But complete game changer in terms of the amount that you'll get back. And this is for only 2021. I apologize. It looks like I have 2 of the same slides, so I'm just going to skip over that. I actually have some notes here. Okay, yeah. So with the dependent child, it must be 12 years or younger at the time the child care is provided. And the nice thing when we say child care or dependent care, this could be for the dependent child, it can be the 12 years or under. And if it's a dependent of an adult, it can be for the care of their well being, like a parent. Um, oops, no, back one. And this could be the taking care of a child, so including the cooking, anything to provide the well-being of a child or adult dependent, then you can include. So in my notes, I have qualifying expenses can go beyond physical care and extend to household expenses, such as paying someone to help cook and clean. So like at right now, my son is home virtual learning. So he does have a nanny that not only helps with his schooling, but does do some cooking for him through the day. So that would include, you know, that cost for her to do those additional service would be considered as part of this dependent care credit. Next, we have the earned income credit. And the change has been really to the age. So prior to the new laws, if you meet the income threshold and you were between the ages of 25 and 65, then you could qualify for earned income credit. With the new laws, they reduce the barrier in terms of age. So as you can see on the slide, if a child or if a person is 19 years old and is working and not a student will now qualify. If it's a student that's 24 years of age and then they would qualify for earned income credit, or if they're an 18-year-old and eligible foster child, considered a foster child, then they would be considered eligible for the earned income credit. And they repealed the upper limit age of that 65. So you can be any age, and if you're working and your income is through under the threshold, so you may have someone retired working part-time, substitute teacher or something like that, and they perhaps could qualify for this earned income credit. We're about halfway through our slide, so yeah, no, a little bit over half. Next, we have the premium tax credit, and this changes for 20 and 21. The premium tax credit were for those that went out to like and got Obamacare, and they got a credit based on their income. And when they go and do the tax return, we would have to reconcile, okay, based on your adjusted gross income and the amount of the credit, they may have to pay back some of that, or they may not have to pay back any at all. So this year was huge in that there is no repayment required. And for example, most clients that have income under 40,000 in this area would generally be able to keep the full premium tax credit that they received on Obamacare. So meaning the federal government is paying the state for their health insurance, and they're not paying out of pocket or maybe a little bit out of pocket. And then when they go to do the tax return, we have the form that they get from the state, a 1095B, and we enter that information of the amount of premium credits they got each month during the year. And if their income is under 40,000 generally, then they don't have to pay back any credit. I actually had one client that just sold some stocks and came into a lot of money in 2020, and they went above the $40,000 poverty level in this area, and they actually had an $18,000 tax bill because that's how much premium credit that they got for their family for Obamacare. So In this case, we didn't finalize the tax return, thank goodness, until we knew what was going on with the stimulus, because that has been removed. So they didn't have to pay that 18,000 on their 2020 taxes. And they've now changed the provision going forward in terms of how do you determine when do you have to repay, because 40,000 is such a low threshold to have to turn around and end up with a $18,000 tax bill. And once again, it's a cliff. So if the taxpayer made $40,001, they're paying that full, in my example, that 18,000 back. So it's not a phase in terms of paying the full amount. It's either you get it all deducted or you have to pay the full amount back. So with the new law, it eliminates the poverty rule of the income being less than 400% of poverty level based on our local area, to using just a straightforward percentage of the income limit to qualify. So of 8.5%, looking at the adjusted gross income, and if it's 8.5% of that amount is higher or less than the premium tax credit determines if they have to pay or not. Lastly, it says section 2305 says if receiving unemployment in 2021, no income above 133% poverty level will count against. So that's even allowing more of non-repayment, looking at the amount of the poverty level being less than the credit itself. So this was one of those things that it was good to have Obamacare, but this kind of snuck up on people if they wasn't, monitoring the amount of income that they were having. I think that was cute. Anyone got student loans? So only for 2021, federal government is not forgiving loans. However, to the extent that your lender is forgiving your loan, so Lakeside or whatever these different companies are, that forgives the loan, with the tax bill, with this bill is saying that you don't have to claim it as taxable income. So the general rule is that if you have any if you have debt that's canceled, we call it cancellation of indebtedness, COD, that actually becomes income to the taxpayer that you have to report. So if you've ever had any, if you've ever settled any credit card debt, more than likely you would have received a tax notice at the end of the year on tax form 1099-C. With this part of the statute, part of the bill is stating is that to the extent that you do get 1099-C based on student loan that was forgiven, you don't have to include it, or it will be excluded from your taxes, and you don't have to pay taxes on it. So once again, the bill does not forgive student loan debt, but if the institution forgives it, then it is not taxable and it can be excluded. The next thing and the last thing as part of the individual relief part before we move into business is the COBRA premium subsidy. So if you're in a place where you're paying for COBRA coverage, the government will now pay 100% of those COBRA coverage premiums for 6 months, beginning on April 1st, 2021 through September 30th, 2021, by way of providing a credit to your employer. Parts of this section does state that it has to be an assistant eligible individual and to qualify for the benefits of receiving the subsidy. So they consider a person that's AEI eligible for COBRA due to involuntary termination of employment or reduction in hours, and actually elects COBRA coverage. Just reading from the slide, in addition, an individual who previously declined COBRA or dropped COBRA and who would otherwise currently be eligible for COBRA if a COBRA election were in effect is eligible for the COBRA subsidy if certain election requirements are satisfied. So generally, a person is allowed to keep their employer's health insurance through this COBRA system, but they are responsible for paying out of pocket when they are no longer an employee. And so this is great in that the government will pay on behalf of that former employee for 6 months the COBRA premiums. And I'm just going to take a quick sip before we get into the small business relief side. Okay. So the SBA targeted EIDL grant so when COVID first hit under the CARES Act 1 and CARES Act 2, they just added additional funding. You could go on to SBA website and apply for the economic disaster loan, and you could do the loan as well as get a up to $10,000 grant advance. And at that time, there was really no requirements other than that you were impacted by COVID in some way. When in December, when they came out with, CARES Act 2, if you will, they basically said that we're going to bring back the $10,000 targeted EIDL grant. However, it's only going to be for people or businesses in low income communities. And based on them being in low income communities, they would have to not only be in that community, but also have received an economic loss of their business of 30% or more. So I did like a 10-minute video a couple of months ago in terms of how you calculate if you're in a low income community. And for the most part, we're in Atlanta, Maryland, and our city didn't even qualify. So I figured a lot of our clients probably wouldn't qualify for this targeted EIDL grant, but I don't want to assume that. But nonetheless, with this bill, it added an additional $15 billion to make those grants, and part of that $15 billion, $5 billion was specifically allocated to do an additional $5,000 supplemental grant. The nice thing with this grant is that you don't have to do anything to apply for it if you attempted to apply for the EIDL under the CARES Act 1 or CARES Act 2. And whether you got it or didn't, SBA will reach out to you and ask you to submit your information. They're going to ask you for 24 months of income for all of 2019, all of 2020. And then from there, they'll analyze that information and let you know if you qualify. But like I said, majority of our clients are not in this low income community. But on the next slide, I will have a link if you wanted to check and see if your city is considered low income community. And here I'm just giving you really the definition of what low income community means, but it has no bearing unless you actually go in there and put in your city and you do a couple of calculations to determine that. And if you wanted to apply for the EIDL grant, this is not like with the PPP, and we're going to get to that next. It's not like the PPP where you can go to any lender and apply for. This one, you're actually going directly to the SBA, sba.gov to apply for it. Okay, the update for the PPP loans in the ARPA bill, there was an additional 7.25 billion of funding, and what they also did was expand it to include larger non-for-profits and expand to include certain tax exempt groups. So really, for ARPA, they just increased the amount of money that's in that fund so more people could have access to that kind of funding, and opened it up more to non for profits. Something that did take place on March 3rd was that the SBA did change the application requirements for Schedule C filers. So prior to that, when applying for the PPP, if you were a sole proprietor or a single member LLC, or you filed a Schedule C as part of your 1040, you had to take the amount on line 31, which was the gross income, your gross revenues, and minus all of your expenses and whatever that net amount is, and divide that by 12 and multiply that by 2.5. Well, a lot of people really didn't have money at the end of the day on that line 31. So they changed it to say, okay, you have the option of using line 1 of the Schedule C for your from your 2019 tax return to apply for the PPP loan. And that's a game changer because we do have a lot of clients that have Schedule C and they do have the gross revenues, but once you get to the net amount, it's either a little bit or a net loss. So now they can apply for the PPP based on their gross revenues. The deadline is the end of this month. The ARPA bill and the change that came out of SBA on March 3rd did not extend the application, but we anticipate the extension because of this recent bill. And just on the 16th of March, the House of Representatives did pass a bill to extend it to May 31st. So I am looking out for more information as that hopefully them extending it, because we have a number of clients that would benefit from this. And with tax season going on, unfortunately, we don't have the bandwidth to actually reach out to every single one of them and say, hey, you should apply for this. But if you are a Schedule C filer and you do not have any payroll, this is a platform, wobbly.com. I'm not affiliated. I don't get any kickback or anything. But just working with different vendors and financial platforms to apply for our clients, this is one that you can actually apply for. It's very easy. And the Schedule C line 1 gross revenues does allow you to double dip, essentially go for the first draw and the second draw. So, and it's based on, once again, your 2019 gross revenues. So at this website, what I like about them is that they have this PPP Express or expedited application, and you submit all of your documentation one time, and it allows you to apply not only for the first draw, but the second draw, as well as your forgiveness piece for the first draw and the forgiveness piece for the second draw, all at one time. So really useful tool, but once again, that is only for Schedule C filers that don't have any payroll. So check that out if that applies to you. The other thing that to note that was changed as far as the PPP loan is who can apply. So prior to this act, as well as the one in December, it was only individuals that had Social Security numbers. So it couldn't be any individuals that was here on visa or I-10s. So that now that does include individuals with I-10s, like with a green card or who hold a visa. And they even are including ex-cons to be included. There are some specific ramifications, and I have them here in my notes, which says they've reduced the barriers for former felons to have increased access for business owners who have either an arrest or conviction for a felony related to financial assistance fraud within the previous 5 years, or any other felony within the previous year. So um, that's something to note there. And I did see something come through the chat, and as soon as I'm able to get to that question, okay, no problem, David. Good having you out. Um, so here we have the employee retention credit, and the employee retention credit is for any business owner that has employees, and based on how much they pay the employee in a quarter, they can actually seek a credit for wages. Is that someone talking? Okay. Um, and with the ARPA bill, it expanded it to include the shutdown of venues or places, so they can still apply for this employee retention credit, or that, you know, that incurred a decline of revenue of 20%. They added a verbiage called new recovery startup option, and that really is just for any businesses that started after February 15, 2020, and it's allowing them to claim the employee retention credit. This credit is capped up to $50,000 per quarter, and I believe it's like $10,000 per employee. So to the extent that you had a decline in revenue, or you were shut down for a period of time, a decline in revenue of over 20%, um, and you have employees that you're paying, you can apply for this credit of up to $10,000 per employee, no more than 50,000 for that quarter. And this bill extends it from June 20th, 2021 to the end of 2021. So a very good thing to look at if you were not interested in taking either the first or second draw of the PPP loans. So this can only be payroll costs that you didn't use attributable to getting PPP loans, or the shuttered venue operators grants, which we'll talk just very briefly in a couple of slides as we're nearing the end, and the restaurant revitalization grant, which I'll be talking on the next slide. With this bill, it states that you can claim the credit against Social Security taxes, where prior to that it was just only wages, but now you can do the Medicare and FICA taxes as well. And to apply, you can begin applying for July 1st, 2021, for the first 2 quarters for Q1 and Q2 of 2021. So something to consider if you're not participating in the PPP loan. And like I said, these other 2 grants, which we're about to get into, and yeah, we're almost done. Hey. So part of this bill that was introduced is the restaurant revitalization grant. To date, there have been 110,000 restaurants closed, a loss of $250 billion from March 2020 through January of this year. And with this bill, it was $28 billion that were set aside for this grant, with $5 billion specifically allocated to business owners that make less than $250,000. The SBA will be funding this directly, so not like the PPP, just similar as the targeted EIDL grant and the EIDL loan. You would go directly to the SBA website. I did see recently that they plan to have this up and running in April. Initially, there was talks that it wouldn't be ready until like July, but they are looking at April at this point. The way that you determine how much, if you're a restaurant or if you, it could be a food truck. I have a link to a website that gives you more details of what type of expenses are qualifiable and what is considered a food store. So you can have an entertainment center and you're going like a stadium that offers food. They wouldn't qualify. It's for what's considered a restaurant or something like thereof, is when people of the public are going for the sake of purchasing food or drinks. And that's how it's kind of defined in the bill. But there is some other stipulations. So the way you calculate the grant is you take your 2019 revenues and you subtract the 2020 revenues. And if you got any PPP loans, you subtract that, and that's your grant. So that's huge. And this is grant, i.e., not repayable. It's money you get to keep. So if a restaurant made $1 million in 2019 and due to COVID they only made 700,000 in 2020, their grant, and they didn't do a PPP loan, their grant essentially is 300,000. There is a cap of $10 million per entity. There's a cap of $10 million per physical location. So you can have 2 restaurants, 2 separate locations, and it's owned by one entity, which has the cap of 10 million. But each location can only get up to 5 million. And there is a 20 location limit, meaning that if you are a franchisee and you have different locations, you can only apply for 20 of those locations and not all if you own more than 20. And then there are some affiliated business rules. And then lastly, just to mention, is with the expenses to document for the grant purposes, I do suggest that you use a separate checkbook or a separate bank account. So if you get the grant money, you begin running your payroll that's not related to PPP or anything like that, or in the qualifying expenses through that bank account, in order to have the proper accounting and record keeping and tracking, because they will be asking for you to show that you used and spent the money as would you required to keep your restaurant open and full operations. So I'm not sure if there's anyone on the webinar that is interested in knowing more about this grant, but if so, to best prepare for this, it's been shared by this link at the bottom, restaurants pluralact.com, they suggest that you get your DUNS number, then you apply on a government platform, which is sam.gov, and do allow 2 weeks for you to do the necessary verification, and then begin organizing your paperwork in terms of getting the 2019 gross revenues together as well as 2020. And once again, you can get the PPP loan and this grant as well as the second PPP loan. So, it's okay if you apply for all 3 of them. You're not going to be rejected if you were to apply for this grant. And it can be used for any operational expenses. So with the PPP, it's more limited because you have to have at least 60% of those monies used for payroll. In this case, there is no type of threshold or minimum that you need to meet as long as it's operational expenses. As I mentioned, the type of restaurant or food business, the primary purpose of that business has to be to feed people. It could be like a catering business. I could see that, a food truck. I can see those types of businesses being able to qualify for this grant. Very quickly, this is the shuttered venue operators grant. This actually did come with the December CARES Act 2 bill. However, it didn't even pick up off the ground because it didn't have a lot of information. But this, with any place that had to close for a period of time due to COVID, they can get up to 45% of their gross income. This allows them now with this bill, the ARPA bill, to get both the grant and the PPP. And I think that's why this didn't really pick up off the ground, because most people opted to do the PPP versus apply for this grant. Now they can double dip and do both. And it's to launch beginning next month in April. And this has to do with if you had at least a reduction of 25% in your revenue for any quarter in 2019 versus 2020. So if you had a drop in any quarter in 2020 compared to 2019 of 25% or more, then you potentially can get up to 45% of the gross income in revenues from 2019 as part of this grant. Once again, operative word is grant, so it doesn't have to be paid back. The business had to be operational as of 2/29/2020. And we do actually have an infographic that's going up in the next few days. So there's a link for more detailed information, and it talks about the type of food store that qualifies. Lastly, and I did have time, so just wanted to talk about these miscellaneous provisions that are in the bill, that was worth mentioning, but not actually doing a formal slide on, is that there are new reporting rules for the 1099-K. So if any of you are doing activity with a merchant such as PayPal or Square, or you receive credit card payments, and the old rules was that if you had to, the merchant company didn't have to issue a 1099-K if you earned less than $20,000 or you had less than 200 transactions for the year. The new rule is if you've made more than $600 from credit card transactions, then that third party issuer must issue a 1099-K. So there's going to be way more reporting going on than before. Next, under Section 9672, the targeted EIDL advance is now not taxable, and all the expenses is deductible. So originally the grant was not taxable, but the monies that you used with the grant, those expenses were not deductible on the tax return. So this just now allows that not only is the grant not deductible, but the expenses with it is allowed to be deductible on the tax return. With the grant, once I mentioned this earlier, it's just stating for the restaurant revitalization grant that it's not taxable. And once again, like the targeted EIDL advance, you're able to deduct your expenses as business expenses on the tax return. And the last piece here, which is big for a lot of employers, is the paid sick and family leave credits. So in previous CARES Act, they were giving a credit for any employee that was out due to COVID for up to 2 weeks or had a family member. So they expanded this, and they pushed back the time that you can actually take these credits. So instead of it now ending on 3/31, the end of this month, it has been extended to September 30th. They have increased the limit of the credit as far as wage base is concerned from 10,000 to 12,000, and they have expanded the reasons for time off. And I did note that in my notes here. So time off can include to receive the vaccine or to recover from any vaccine related illness or injury. And they can claim it they can double dip. So if an employer claimed it in 2020, they are allowed to claim it again for 2021 if it's the same employee. So maybe last year an employee was out due to COVID, but this year they're out because of going to get the vaccine and fell ill to it, or they got COVID again. So it does allow for an employer to take credit on the same employee up to 2 times, once in 2020 and once in 2021. So this concludes everything that I wanted to share with you as far as the ARPA bill. I know it was a lot of information, so I will be happy to take any questions that you have at this time. And just real quick, for anybody that's a new business owner or even an existing business owner, this is a fee-based webinar that I do monthly. And I limit it to only about 15 people, so it can be, nice and intimate, but I talk about the meats and potatoes of having a business. How do you pay yourself? How to do record keeping, tax compliance, and all that good stuff. So that will be next Wednesday at 3 o'clock. So if anyone is interested, I'll be more than happy to have you participate in that. And the link is above here. So if you just go to the website and do /new-business, you can register from that page. So any questions at this time? I am going to stop the recording.